Hey guys, great to be here. I'm going to be talking about two things today. One thing that's probably that everybody loves, which is crypto. The other topic is taxes. That probably, not the most favorite subject. But it's a timely thing to talk about because tax season is coming up. So stick around. I'm also going to talk about some of the ways that you can save on your crypto taxes as well. A little bit about me. My name is Shihan, CPA, head of tax strategy at CoinTracker. Some of you guys might be aware of the company. It's a crypto tax software company. If you guys want to find me on Twitter, it's my handle. So this is what we're going to cover today. Just mainly three things. Not going to go into too much details. We're going to talk about crypto taxes, what you really need to know about, tax saving strategies, and how software can help you, stay out of the IRS trouble. Just know that this is not tax advice. If you have any specific questions, feel free to consult your own tax professional. Want to kind of give you a quick overview of where we are in terms of accounting and tax compliance. I'm not going to talk about the gray area here because this is the crypto space. As you know, the Bitcoin came into circulation around 2009. From there onwards, the prices, went up and up. 2014 is the first time the IRS came into the picture and said cryptocurrencies are taxed as property. So since then, the space has moved a lot, and now there's a question about cryptocurrency on the tax return that you file. A lot of people don't like this question on this tax return, but I see this as the IRS doing us a favor. They're doing free marketing for cryptocurrencies by putting this question on the front and center of the Form 1040. This form is filed by 160 million US taxpayers. So everybody's going to see that. And this is great for the adoption, in my opinion, although it's kind of annoying answering this question. The question is pretty much asking, hey, are you dealing with cryptocurrencies? It's a yes and no question because IRS wants to know, what you're doing with cryptocurrencies, if you're paying taxes, because there are, the number of people with crypto in the US is around 50 million or so, but the number of tax returns that the IRS is getting with cryptocurrency transactions are in the low thousands. So there's a huge discrepancy, and IRS is trying to educate the people to, report it and file the taxes. So let's go to the tax overview. So just know that cryptocurrency, even though we call it a currency, it's treated as a property. So easy way to think about it is that think of cryptocurrency or coin or NFT like any type of stock. So you have a purchase price, you have a sales price. If you make a profit, you pay capital gain taxes. That's just a simple way to kind of know how taxes work. So the next question, when do you have to worry about taxes, right? So these are the 5 situations that you need to keep in mind. And if you go through any of these situations, you could have a taxable obligation. So number 1, pretty self-explanatory. It's selling crypto into fiat, just cashing out. You got to pay taxes on the profit that you made. The number 2 is where a lot of people get confused. It's when you go from one coin to another, or one coin to an NFT, or NFT to an NFT, you still have to pay taxes even though you're not realizing any cash. So be careful there. And number 3, when you spend cryptocurrencies to buy a Tesla or buy a subscription service, any type of service, that triggers a taxable event. Number 4 is becoming more and more common. Like a lot of people like, passive ways of, earning income, like, staking income, mining income, those things get taxed. And the wages is becoming a huge issue because a lot of these DAOs are paying their contributors in some type of token, and that's taxable at the time you receive them. And the last one, airdrops and hard forks. Hard forks, we haven't seen them a lot lately, but airdrops are becoming more and more popular. Today, there was an airdrop on the Ape coin. So if you receive that, if you claim it, that's a taxable event at the time you claim it. So remember these 5 situations. The next question is, okay, I know the 5 situations, so what kind of taxes do I have to pay? It depends. It depends on how long you keep the coin before you sell that coin. So there are 2 buckets. There are short-term capital gains and long-term capital gains. Short-term capital gains occur when you sell your coin after holding it for less than 12 months. So the tax rates for short-term capital gains go from 10% to 37%. The long-term capital gain rates are pretty favorable. But to get those rates, you got to sell the coins or NFT after holding it for more than 12 months. So you got to have a bigger holding period to get those favorable rates, because the highest rate for long-term capital gains is 20%. highest rate for short-term capital gains is 37%. So there's a huge difference. So if you really have to cash out, at least keep it for 12 months. That's going to give you a huge amount of tax savings. NFTs. So let's talk about NFT for a second. They're taxed very similar to cryptocurrencies. You have a purchase price, you have a sales price. If you make a profit, you got to pay taxes on that. Buying an NFT is a taxable event if you're using Ether or any type of cryptocurrency to buy that. And obviously, earning royalties are taxable as well. Your tax situation kind of depends depending on your classification. If you're an investor, you're subject to capital gains and capital losses. If you're a creator, there are different types of tax implications that you need to keep in mind. So something to think about. Okay, a famous question that probably everybody is afraid to ask. I mean, I see this question on social media all the time. Crypto is anonymous, in most cases pseudo-anonymous. So how the hell the IRS knows that I have crypto, right? These are the 4 ways. If you're dealing with any type of centralized exchange like Coinbase or Gemini, etc., if you get any type of tax form, that means exchange has already reported your information to the IRS. So if you get this 1099 form and don't report anything on your tax return, you're definitely going to get an IRS notice saying that, hey, why did you report this amount? So if you get the 1099, that means your information is already with the IRS. Number 2 is through subpoenas. So IRS and other agencies issue subpoenas time to time. And if your name gets leaked through one of those subpoenas, then IRS has your information. Number 3, from the crypto question that we kind of went through in the beginning, you have to answer that question, and you're signing your return under penalty and perjury. So if you intentionally lie, it could fall under fraud. So if you have crypto, make sure you say yes, because don't be fraudulent. And then by giving that information, IRS knows that you have something to do with crypto. And then finally, blockchain analytics. Like IRS is working with companies like CyberTrace, chain analysis to tie these pseudo-anonymous wallets and identities into real-world people, and that's how they audit certain people as well. So these are the 4 ways IRS knows you have crypto. The TLDR here is that crypto is not anonymous. It's one of the worst asset classes to evade taxes on, because whenever you do a transaction, there's a permanent record about that transaction on the blockchain. So it's a matter of IRS kind of tying that transaction into you one day. Speaking of IRS is, see this industry as a place that they can make a ton of money. So they have deployed certain missions to catch crypto tax evaders. IRS is more bullish on crypto than anybody else because they got a ton of money to make out of here. I'm not going to go through this slide, but this slide kind of summarizes tax implications for different type of transactions, trading, mining, and etc. And then because I want to have a lot of time for some questions as well. Okay, let's cover this, getting paid in crypto. So as I mentioned earlier, in some tech companies, you have an option to get paid in cryptocurrencies. And as DAOs are becoming more and more popular these days, contributors are getting paid in some type of native token. So make sure that you have to report that as income, even though you might not get a W-2 from your regular employer. And it's your responsibility to report that and keep all the good records for 7 years. And the third point is important because when you get paid in those tokens, it's your responsibility to allocate a certain amount of tokens, roughly 20, 30%, depending on your tax bracket, to cover your federal and state income taxes. Because the good thing about working for a regular employer is that when you get that paycheck, the employer has withheld all the taxes. So at the end of the year, you don't have to worry about paying taxes. But if you're working for a DAO and getting paid in a token, you gotta cut these checks every quarter to meet your tax obligations. So a lot of people forget that, so something to keep in mind. IRS has been sending these tax notices time to time. Again, IRS get these information through some of the subpoenas that they issued to Coinbase, and last year there were subpoenas issued to Kraken and one other exchange. So expect these tax notices to come out. And sometimes you get these things even though you did everything 100% correctly. And don't get panicked when you receive these things. I wrote a guide on how to kind of deal with these things and how to rectify your issues in case you're curious. So the reason why I'm putting it here is that even if you do everything correctly, you might get tax notices for whatever the reasons. And in that case, don't panic. Just explain to the IRS, hey, I reported everything. and these are the records. If you ask me the most important slide out of this presentation, I would point you to this slide. This is like a technical concept that a lot of people are not aware of. This is a concept called statute of limitation. Just because they're IRS doesn't mean that they can come and audit you at any time. So if you properly file your crypto taxes, IRS can only come after you for the next 3 years. That's called the statute of limitation period. But if you substantially understated your income, meaning you didn't report 25% or more of your income, that 3-year statute of limitation gets extended to 6 years. And if you don't file any type of tax return saying, crypto is completely invisible, that statute of limitation never starts. That means IRS can come after you when you're 80 years old and audit you because you never started that default 3-year statute of limitation. So the TLDR here is that filing something is better than filing nothing, because when you file something, it starts the statute of limitation. You're limiting your risk to that 3-year default period, and IRS cannot come after you after that 3 years, unless obviously you understate your income by more than 25%. So filing something is better than filing nothing. Okay, so let's talk about tax saving strategies. These are things that you guys can do actively. You don't need any experts. So 3 ways to save on taxes. You can eliminate taxes, you can reduce taxes, so you can defer your tax liability to tax years where your income is going to be lower, like when you're close to retirement. One thing that we should actively do is this thing called tax loss harvesting. As you guys know, the market goes up and down. Whenever your positions are in the red, meaning the market value of the coins are below how much you paid for it, you can sell those positions, harvest the losses, and quickly get back into the same position if you really believe in the coin or the NFT. So these harvested losses can be used to offset your crypto gains and your stock gains, and even in some other type of incomes as well. So highly recommend just look at your portfolio every quarter, every month, or every other week. Just see which coins are in the red. Just sell them, harvest the losses because losses are good for taxes, and then get back into the same coin at the lower price. The second one is super important, and to do this, you need some type of tool, like CoinTracker. The FIFO or LIFO and HIFO, these are called accounting methods. These signal the IRS which specific coin or NFT you're selling for tax purposes. Ideally, what you want to do is if you're selling a coin, you want to sell the coin with the highest cost basis. When you do that, you mathematically reduce the capital gain taxes that you pay on, because the capital gain taxes is assessed on the gain, right? The gain is calculated by subtracting cost basis from the sales price. So if you have been dollar cost averaging, let's say Bitcoin or something, and if you want to cash out, you want to sell the coin, the Bitcoin, which you paid the highest price first. That's called HIFO accounting. When you do that, you reduce that capital gain taxes by a lot. So very, very important thing that you can do if you have to sell. Also know that there's 0% long-term capital gain tax rate. Again, something that a lot of people are not aware of. Just to remind everybody, to get the 0% capital, first of all, long-term capital gains happen when you sell your coin after holding it for more than 12 months. And if you sell something for more than 12 months, and if you fall under one of those categories, let's say if you're married, filing jointly, and your total taxable income is less than 80,000, you pay 0 taxes. So very powerful. Again, you got to plan things, and because if you have 80,000 of crypto gains and you have like a $20,000 W-2 salary, then you won't be subjected as 0% because the 80% has to be your overall taxable income. But there could be situations where you could use this strategy as well. Donating crypto, one of the rare situations where IRS gives you 2 benefits at once. You get the write-off, and you don't have to pay capital gain taxes on the coin at the time you donate them. SelfDignitary crypto array, they have becoming super popular. These are ways that you can save for retirement using cryptocurrencies without paying taxes today. So you can do trading and so many other things inside these SelfDignitary crypto array accounts that you don't pay taxes today, and you pay taxes when you take out the money into your retirement. And in some cases not, if you set it up as a SelfDignitary Roth IRA. Okay, so those are some tax saving strategies. So what is CoinTracker? Some of you guys might already be familiar with it. It connects with your wallets and exchanges, applies the latest tax rules and the saving strategies, and gives you the tax forms you need to file with your tax return. So I recommend you guys checking it out if you haven't filed your taxes this year. What are the key takeaways before we go into the Q&A? Just make sure calculate your crypto capital gains and losses using a well-recognized software, because the crypto space is not like the stock space where you can go to Robinhood and then download that tax form. It is your responsibility to connect your MetaMask and OpenSea and all the exchanges to a tool like CoinTracker and reconcile your capital gains and capital losses. And do not think crypto is invisible from the IRS. It is not. Number two, yes, paying taxes suck. Also know that there are tax planning opportunities that you can do, like tax loss harvesting, using the right accounting method, and etc. And then finally, file something to start the statute of limitation. Just do not give the IRS unlimited time to come and audit you. Just by filing something, you're limiting your exposure to 3 years from the date you file your return. And after that 3 years, IRS cannot come after you. So these are the takeaways. With that, I think we have a few minutes. If you guys have any questions, I'm happy to answer. Yeah.
So I do believe today was the last day to file our taxes.
It's April 15th. You have time. Yeah.
So I have an accountant and a bookkeeper who are already doing that for me. Should I now tell them, hey guys, I forgot to tell you about crypto?
You should definitely, yes. Yeah.
Will CoinTracker be supporting Cosmos or any of the other blockchains anytime soon?
Yeah, I think so. We prioritize features based on the community upvote. So I don't know where Cosmos stands in terms of the priority, but yeah, we hope to support everything one day. Yeah.
Moving assets from chain to chain, swapping, doing anything in the space, any of that triggers an taxable event or only when I cash out?
Are you talking about bridging? Bridging, again, IRS hasn't said anything directly, but if you ask me and if we apply the general tax rules, it's not a taxable event because you're transferring an asset from Ether to Arbitrum or something like that. It's just the same asset. So it's not a taxable event.
We move to a stable though. Is that taxable event?
Yeah, of course, yeah. If the coin has if the coin has appreciated, let's say you got Ethereum at $1,000, at the time you convert it to stable coin, it's worth $2,000, then you got to pay taxes on that $1,000 difference.
So I guess it's sort of a question around the airdrops and how that's taxable. Sorry if it's a little complicated, but I'm sure people sitting on Ethereum wallets where they get some random shitcoin that's sent to them and it has no liquidity, but it's worth like $20,000, and you didn't have any affirmative action, like it's just sent to your wallet with no just your address is sitting out there on the Ether. Is that something? Is the IRS look at that and say, oh, you got $20,000 of income, now you have to file that, or is there some way to say, like, look, I didn't want this money, I'm not liquidating it?
Well, most of those S coins at the time you receive it, they don't have a value. So that's the good news, right? If it has a value and you still don't want them, you can send it like a null address and kind of dispose it as soon as you get it. So that way you're not taking the tax burden. So, yeah.
Is that a write-off?
It depends. So let's say at the time you receive the coin, it's like $20. At the time you send it to the null address, it's like $5. Right. Then you got a $15 write-off. Yeah.
And then to follow up on what you were saying about the crypto donations, is that the day you file?
The day you donate.
The day you donate?
Yeah. I think this might be the last question because I'm running out of time.
So in terms of two things. One, don't send scam coins to the null address because people can have bad logic in them that can compromise your wallet. But second, what about staking and stuff? So this is the thing that's been the biggest pain in my ass. I stake a bunch of stuff and
Yeah.
and most of the tax software I use reports that it's basically selling it and then rebuying it. Do y'all do staking or just?
We do staking. I cannot say we support staking for all the platforms, but the Tezos and the general ones, we do them. IRS hasn't issued any staking specific tax guidance. The conservative route is to report income every time you receive those staking rewards. I know it's pain in the backside, but that's how it is, unfortunately.
So if I stake my LP token or something like that, I'm not losing custody per se, but they're paying. So the rewards obviously are going to be, but I mean when I unstake them, you handle the staking and unstaking is not
It depends on the platform because it depends on the platform. But I'm happy to answer that question offline. But guys, I want to answer more questions, but I don't have time. But thank you very much. I'm going to be here if you have any questions.